Welcome to Seeking Alpha's CEO Interviews. Quality of leadership is a decisive factor in stock performance, so we provide in-depth interviews with the best and brightest CEOs in the public markets. We publish limited excerpts from our interviews on social media platforms and the full interviews at seekingalpha.com and in the highly rated Seeking Alpha mobile app. To find the full interviews, open seekingalpha.com or the Seeking Alpha mobile app and search for the phrase CEO Interviews, or simply type a stock ticker into the search box.
Hi, I'm Josh Bauman, and today my guest is SPAC CEO Chieh Huang, and he just announced earlier this week a deal with Seven Oaks, which is a SPAC, to go public in a deal that's valued at about $900 million. How do you feel about that, the deal? What prompted that?
Yeah, Josh, well, thanks for having me. First of all, it's great to be here with you. Exciting times for us, and yeah, it's our foray into the world of SPACs. So as you mentioned, we are merging with Seven Oaks Acquisition company, and a few things triggered it, and a few things triggered why we really liked the de-SPAC product and process versus a traditional IPO. First and foremost was the quantum of capital that we can raise. So we set out to raise a good deal of capital above and beyond what we could traditionally raise in a traditional IPO from very good investors. So that was first and foremost. Second as well is that a lot of folks out there will now know, just because as we go public and as we kind of tell the world and tell the public about our story, that a good amount of our business is actually from B2B, as well as going forward, software sales. And so our B2B business, which is traditionally almost a quarter of our business, had pretty huge headwinds throughout COVID. As you can imagine, most folks weren't working in the office. People were working from home. Our Fortune 500 clients weren't ordering from us. And so being able to tell that story to the public of what this looks like after we return to work, after our B2B business recovers, was really key. And so those two things we could not do with a traditional S1 or with a traditional IPO filing.
Any particular reason why you picked Seven Oaks? What do they bring to the table?
Yeah, so a few things. So Seven Oaks, for folks out there who don't know, Seven Oaks is actually an ESG SPAC. So at first you might be like head scratching, like, what is Box doing merging with an ESG SPAC? But when you actually understand the Box story, not only what we do, but how we do it, it really starts to come together. So first and foremost, we on average sell about 100 items per order, or sorry, $100 per order, and about 8 items for our typical B2C customer. Our B2B customer is almost double that. And so when you ship all of those items in a single box or a single shipment from one fulfillment center, it is way better for the environment than shipping 8 items via 8 separate boxes showing up on your doorstep over 3 different days. So that's first and foremost. Second, the stance that we take on really important societal issues, like whether it's the pink tax stance that we take or other items or other things that we do within the company, really go to the S portion of that ESG part. And also a corollary to that, we will be, by all accounts, and with regards to all of the research that we can find, one of the only publicly listed American or US-based companies where the corporate office is majority minority. So the majority of our corporate presence in the US identifies as an ethnic minority, which is also pretty rare. So again, all those things kind of yield this ESG SPAC that we're merging with.
Gotcha. Have you, since you announced, since you are, an ESG sort of company, have you gotten interest from, funds that seems to be, the name of the game in the last couple of months? Are you getting interest from those guys, from investors?
Yeah, absolutely. Both in the aftermarket or after the announcement, as well as even before. So when you think about the world today, there's probably not a lot of e-commerce companies with that can, with a straight face say they're on an ESG mission. We've got over 7 years of a track record since we first started on this mission of being ESG focused. And so for the money managers out there and for the investors out there that want e-commerce exposure, but also want ESG exposure, there's not a lot of names to go after, and I think hopefully we'll be one of them.
That's great. One thing I was looking at in particular in the SPAC that, the pipe portion was relatively small. I want to say around 32, 35 million or so. Is there any reason why that pipe is smaller? And it seems like you're using more debt than traditionally people have done lately, I guess.
Yeah, absolutely. So remember when we set out on this mission, it was really to raise a large quantum of capital from high quality investors. We ended up doing that with a lot of kind of name brand investors on both instruments, not only the common part of the pipe, but also the convertible part of the pipe. And so from our standpoint, it is a job that we got done. With that said, the market dictates the structure, and given the timing of everything, and given kind of where we were and how we were positioned as we announced a de-SPAC, we think it's still a good result. The convertible instrument, I think, is also a good product that's advantageous both for investors as well as the company. So, but rule number one and kind of mission number one was to get high quality investors, and we ended up doing that.
Gotcha. I mean, just one more point on that. I mean, SPAC has become sort of a four-letter word in the last couple months. Did you have any thoughts of maybe not going the SPAC route and going through traditional IPO route?
Certainly, definitely as we were launching the process, that was certainly a thought of ours. I think everyone out there, it would be tough to sit in a boardroom today and think about a public outcome for a certain company and not debate all the different instruments available, whether it's direct listing, SPAC, or a traditional IPO. But for those two reasons that I mentioned before, the quantum of capital and the ability to tell the story after B2B recovers and after we sell additional SaaS products, that was really the dispositive kind of factors that pushed us towards the SPAC route versus the traditional one.
Gotcha. On the SaaS, I think you announced recently a deal in Asia. If you could explain that, and then also, I'm not sure when that was exactly, but do you expect more of that?
So I'm glad you bring it up because it is an exciting part of the overall Box story. So we started off by selling the potato chips. We then started selling the advertising behind the potato chips, and now we're selling the software that sells the ads, that sells the potato chips. So all that technology that powers our core business here is built by ourselves, or just about all of it. So front end, website and app, inventory management systems, warehouse management systems, even down to the physical automation robots we engineer and put together ourselves. So when you think about what COVID has done to the retail world, there's no retailer on the face of the earth today, in my purview, that's saying, "Wow, we don't need to up our game when it comes to e-commerce." So us packaging up that suite of technology we built and licensing it to big retailers and enterprise clients around the world is core to our plan when it comes to our SaaS business. Eon, one of the biggest retailers in Asia, an $83 billion revenue company, vetted the platform and ended up selecting us to revamp their Malaysia business.
Wow. I'm not sure if you said, can you say, how much of the SaaS percentage of sales you want to get to, say, in a few years or next year? Or?
Yeah. So, in the filing, of course, we disclose all these things. So this year, this is our first year in the SaaS business. We're projecting out $12 million in software sales this year. And so those are aggressive targets for year one of a brand new business line. But we're confident that we can hit it. So you could tell how bullish we are if we're projecting out that number even in year one.
Gotcha. What lessons can you say? I mean, you discussed a little bit before, but what lessons can you say that you learned from COVID, from the as far as the business? Do you expect any of that business to be sticky? How do you see things?
Yeah, I think one is how quickly the world can change, and that goes for even us and continuing to kind of push forward our business model. That was the overall more esoteric lesson that I learned. But I also think too is that, and maybe this will equally be as esoteric, but having a vision and sticking with it takes time. And so when we started off in a garage 7.5 years ago, it was really hard to convince people that people were going to buy toilet paper, laundry detergent, and potato chips online. But we stuck with it. The industry tailwinds are now in our favor, both B2C and B2B. And that came to fruition, or came to a hilt throughout COVID. What we're really excited about is the return to office and return to school, because again, that B2B business saw huge headwinds last year that we hope to reverse this year, or that we hope will reverse this year as people go back to school and back to work.
Gotcha. What about, competition? Obviously, you have Amazon, but now you also have Instacart. I think it's one called Gorilla. You have GoPuff, which seems to be advertising like crazy now. I'm not sure if that's necessarily a competitor, but how do you see the competitive landscape? Where do you see yourself sort of landing?
Yeah, so I really think when you think about how to differentiate, the way to think about it, at least how we do so internally and how we debate it internally, is what do we do and how do we do it? And so when you come to what do, we specialize in wholesale. So folks looking for a single pack of gum, a single small bag of chips, there's great services out there that will deliver that to you in 10 minutes or less. That's not our business. Our business is really big stock up trips, folks and families and businesses really looking to stock up and buy 8, 9, 10, 15 items per shop. So again, Amazon does not specialize in that. None of the names that you mentioned really specialize in that. Two is, how do you build a basket? So most of the names that you mentioned, they're not driving 10 to 15, 8 to 15 items per order like we do between B2C and B2B. And so building a user experience where it's conducive for people to build such a big basket, again, what we do is differentiated. Of course, what we do also when it comes to the B2B business, selling the software, that further differentiates us from the names that you mentioned. Lastly, how we do it. So from a single shipment coming to your doorstep instead of 2 to 3 small boxes over all these different days, whether it's our ESG mission, how we treat our frontline employees, all of that changes how we do it compared to what the names that you mentioned. And so what we do, how we do it, we think it's very differentiated.
Gotcha. Just thinking about, I know Domino's has a commercial where there's little Noro, I think it's called, a little robot is delivering stuff. Is that something you guys, it would have to be a bigger robot, it's an autonomous vehicle. Is that something you guys are thinking about down the road or anything?
Certainly. So, autonomous deliveries in the future, I think it's not, if, it's really when. No one can really tell you if it's going to be 5 years or 50 years, but it's a matter of time. What we're currently fighting and the battle that we think we're well positioned to win is inside the 4 walls. So not even before it goes out of the 4 walls, but how are you efficient in picking and packing these items? And that's where we've spent our automation time and the focus of our automation robotics. I think though, when we get to that world where, you can deliver something autonomously, and it's well known that, your local package delivery is going to come via an autonomous van that just parks in front until you pick it up, or just ejects it out onto your lawn or whatever it ends up being. I think what you're going to find there is that the largest part of the unit economics of e-commerce companies is going to go away, meaning that delivery cost in a good way. So that cost item is going to heavily crater. And when you can end up buying something online for cheaper than if you spend time going into a store, I think it starts to become the point of no return for e-commerce. It just becomes like, hey, do you want to go in the store and spend more, or do you want to sit at home and get it delivered and spend less money at the same time? I think that day will come. I think by going public, we will hopefully be able to take advantage of that day when that technology gets there.
Gotcha. I really enjoyed your interview on with Guy Raza, How I Built This, and I imagine that you like that. And I don't know if you listened to the one with the Jet.com CEO.
Sure.
But yeah, I'm just curious if obviously that was he started a lot of these businesses, to me, sort of similar, sold out to Walmart. So 2 questions. One, any lesson you learned from that interview, and 2, ultimately, what's the goal for you guys? If Walmart came, knocking at your doorstep, what would you have to do?
Yeah, certainly a lot of respect for all e-commerce founders, Mark included. Even fewer of us that grew up in New Jersey that started e-commerce companies. So there's a lot of similarities. I think anyone in this arena, I have a lot of respect for, because again, it takes a lot of execution to go from zero to where they ended up and where we are today. I think for us, we took a different path, a path that's going to lead us into becoming a public company. So a slightly different path, but both I think equally, hopefully will be well respected by the market and by other operators out there. But the main lesson is that, when you hear his story, how they did it, how they did it with diapers.com and Quidsy, there's just so many similarities, and that we all start from humble beginnings. And then the really successful folks, the folks that can really persevere, end up with the best outcomes.
Definitely. Last question. I mean, it's an open-ended. Is there anything that you think investors, the SPAC, it's sort of little change, I'd say, since the announcement. But is there anything that you think investors don't understand that you'd like to clear up or, want to emphasize?
Absolutely. So we are not only an e-commerce retailer, but we are also now an e-commerce enabler. And I think a lot of folks who know of Box because they buy toilet paper and Oreo cookies from us don't really know the other side of our business. The real excitement is that it's very clear where we're going with this business. The B2C business, selling, selling kind of pantry snacks to your family and to your household. We just think the tailwinds from COVID are going to continue. I think it's one of those things where people try and just say, well, I should have bought some of this stuff online to begin with. So with some marketing dollars that will be enabled by the de-SPAC kind of cash and trust, we'll be able to take advantage of that. The second pillar will be the B2B business. As folks go back to school, back to work, we have a very considerable B2B business that shrank greatly last year that will now recover. Third, we're now e-commerce enablers. And we're going to sell all the software and technology that enables the first two pillars and create a third pillar with it that's already generating revenue today. So that's really the three-pronged Box story. And when you dig one level deeper, you get outside of just describing us as toilet paper purveyors to like, oh wait, there's really three pillars here that each could be huge opportunities.
Okay, I appreciate the time. This has been Josh Feynman for Seeking Alpha CEO Interviews. Thanks a lot.
Thanks, Josh.